Hello and welcome. In this tutorial, I'll dive into two key types of retracements. Retracements often occur after the market reaches overbought or oversold conditions. Understanding these retracements can help you make better trading decisions and avoid unnecessary losses. I'll be using the Deriv platform in this tutorial. You can access it through the link in the description below. To identify these retracements, you'll need three indicators, but keep in mind that I'm not using these indicators to generate any signal. The first is the moving average indicator. In the sidebar, click on Indicators, then Moving Averages, and select Moving Average, which will appear as a red line. Next, I'll add the Bollinger Bands indicator, which has a simple moving average. In the sidebar, click on Indicators, then Volatility, and select Bollinger Bands, which will display as three white lines, but I'm more interested in the middle white line, which is the simple moving average. Then I'll add the stochastic oscillator, which is a momentum indicator that helps identify overbought and oversold conditions. In the sidebar, click on Indicators, then click on Momentum, and select Stochastic Oscillator, which will appear at the bottom of the chart. The first step is to always identify the dominant trend on the one-day chart. I explained how to check for the dominant trend in the previous video, and I'll link it at the end of this video. Once you've identified the dominant trend and used drop-down analysis to examine different time frames, it's important to be aware of the two types of retracements that may occur. The first type is a retracement to the simple moving average. A retracement to the simple moving average is a shorter pullback that occurs when the price pulls back only to the simple moving average and then continues with the dominant trend. I'll illustrate this with the same bearish dominant trend example in the previous video. The one-day chart was in a bearish dominant trend, and smaller time frames were also in a downtrend. On this 2-hour chart, at this point the price was oversold and retraced only to the simple moving average, then continued with the bearish dominant trend. This can also be seen on this 8-hour chart. At this point when it was oversold, it retraced to the simple moving average, then continued with the bearish dominant trend. When a retracement stops at the simple moving average, the overbought or oversold condition may easily extend to the next larger time frame. The second type is a retracement to the moving average. Retracements to the moving average are longer pullbacks. They are more prolonged than those to the simple moving average, and they occur when the price retraces further, reaching to the moving average before continuing with the dominant trend. During the bearish dominant trend, this 4-hour chart, after reaching oversold at this point, the price retraced all the way to the moving average, and also at this point when it was oversold again, it retraced up to the moving average, then continued in the bearish dominant trend direction. These two types of retracements can also be seen in other time frame charts. As I mentioned in the previous video, whenever a time frame is overbought, the buy is stronger than the sell, and whenever it's oversold, the sell is stronger than the buy. And because of this, it's crucial to wait for a candlestick signal to confirm the start or end of a retracement. I had already illustrated this in the previous video that I'll link at the end of this video. Retracements are riskier to trade than the dominant trend because it's difficult to predict whether the retracement will stop at the simple moving average or continue to the moving average. Sometimes the retracements extend beyond the moving average of the big time frame chart that's retracing, leading to unexpected price movements, and that's a stop loss hunting strategy. I'll do another video to illustrate more about the stop loss hunting strategy. This is why top-down analysis is essential, because it helps you see the bigger picture and avoid getting caught in short-term market manipulations. To summarize, retracements to the simple moving average are shorter and often signal that the overbought or oversold condition may extend to the next larger time frame, while retracements to the moving average are longer and take more time before the dominant trend resumes. Always wait for a candlestick signal, for example a pin bar, engulfing candle, or doji, to confirm the start or end of a retracement. Understanding these types of retracements will help you avoid unnecessary losses. In the next video, I'll illustrate how to trade the dominant trend. If you found this tutorial helpful, don't forget to like and subscribe. Thank you.